Perfect. All right, welcome everybody to this edition of the monthly updates. So we'll start this with a little disclosure here saying this is for educational purposes only. It's going to be general in nature, but at the end of this, we're going to go through just a couple slides, brief market outlook, and then our topic of the day on government deficits and bond yields. And then we'll just save the majority of this will just be open-ended for your questions. So without further ado, take it away, Lyman, with the market updates to date.
I'm going to surprise everybody, and I've got a very short, quick detour, and that detour is to introduce Dylan Driscoll, who I don't think has been on one of these calls before. He's our newest employee. He started at the beginning of June. He's a recent Bentley University grad, and he's a paraplanner with us here at the team at Financial Planning Solutions. So welcome, Dylan.
Thanks, Alan, and nice to meet you all on the call.
So to start off, I think we have a chart, right?
Yeah,
Andrew, that we get some inputs from and discussions about what we should talk about next in terms of kind of the update here. And certainly federal finances with both the House and the Senate working on proposed budgets for the federal government has been kind of a top of mind topic. So we take a moment and just discuss a little bit about where the money comes from and where it goes. And this neat little chart here that JP Morgan put together does a really terrific job summarizing both spending and income that the federal government gets. And with all this talk of big budget deficits and possible larger trillion-dollar new budget. Thought that this would be a good place to start. And as you can kind of see here, it's broken down on the left-hand side, starting with the orange bar, non-defense discretionary spending is just about $1 trillion a year, followed by defense spending, which is another 859 billion. Other mandatory spending, followed by Medicaid, and then followed by Medicare. Medicaid is, for those of you who don't know, that's the health care system for the poor, effectively. And then followed by Social Security, and then interest on the debt, which in the last couple of years has been an increasing percentage of the overall federal spending is just paying the interest due on U.S. Treasury obligations. So, and that is, if we remain at current levels of interest rates, that is expected to eat up a bigger share of the federal government budget. How does that get funded? Well, the big piece here, of course, is that we're spending a whole lot more than we're taking in, and the white box is the deficit, which really comprises the difference between what we're bringing in and what we're paying out. So this is based on the 2025 federal budget. So $1.865 billion is the proposed budget deficit. This is I believe it was from the House proposal. So
yeah,
the Senate is working on their version, which will likely be different than these numbers will be likely different when they finally arrive at the finalized budget. So in there, you've got corporate taxes, which was kind of a surprise to me the first time I saw this chart. I thought that corporate taxes would be a much bigger piece, but it's actually personal income taxes is really the biggest chunk of income that the federal government has. And then payroll taxes, the so-called FICA taxes, which is Social Security and Medicare taxes that are taken right out of workers' paychecks. And that's really it. There's some other things. Um, and of course, kind of in that white box is tariffs, which are projected at 80 billion, which is just around 1% of the budget. So it's a pretty small number in terms of their expected contribution for the upcoming budget. Um, One of the things that has been proposed by the new administration is to continue the um, tax cuts that were enacted in 2018 under the first Trump administration. And by extending those, we see on the right-hand side, top left, in the red, the TCJA extension. Those little red bars are the additional amounts or the additional cost above what it would uh, cost otherwise if those tax cuts expired as they're planned to expire at the end of this year, December 31st. So if Congress doesn't act, those tax cuts would expire normally. The Trump administration, of course, is very interested in extending those tax cuts and adding additional tax cuts on top of it. It is going to increase the long-term deficit. And the bottom right, we see one way to kind of look at that and put it in perspective is to think about the federal government debt in terms of percentage of the GDP or the gross domestic product, which is basically a measure of how much goods and services are produced in the United States. So when you end up spending even more and you have a bigger budget deficit, that is going to lead to a higher percentage. And a few years ago, we crossed over, well, at the end of 2024, we were at 98.2% of GDP. And now we are above that. It's expected by 2035 we'll be at 118.5%. I think that's what that says there. It's a little small type. But basically being more than 100% of GDP in terms of the debt, the net debt, kind of puts the country in the category of some smaller countries that have had serious fiscal problems over the years. And I think that's where a lot of the discussion about federal government spending has kind of hit the top of the headlines lately. So nothing is final. I guess a couple of things to think about in terms of what you've been hearing and seeing in the news is that both the Senate and the House have to come to an agreement on what the final bill is going to look like. There's certainly a lot of uncertainty about what that's going to be. Will they be able to agree? Um, and I guess kind of depending on your viewpoint on and your confidence level in the House and the Senate, that probably is a determining factor as to what's going to get done and will it get done. It is looking increasingly unlikely that they will achieve an agreement by the July 4th self-imposed deadline that the White House had asked for in order to speed along the new budget. But we'll see. It certainly has been a year of surprises so far. Um, you know, I guess, perhaps the other thing that might be on people's minds would be, is this a level of debt that is going to be completely ruinous to the U.S. economy? And, I guess our perspective and the perspective of a number of the market strategists and economists that we follow is not yet. But the bond market, which is, usually a kind of a gauge of how healthy things are when the U.S. government has to go out and borrow. Um, there have been a few disruptions in um, issuance of U.S. Treasury securities that normally don't have any disruptions at all. So, but day to day, and at least in the last week or so, things have been continue to be relatively smooth in that space. So we'll see. We're keeping an eye on it, and we're keeping an eye on what the um, budget deficit's going to look like, and we'll see. It's hard to know until, as has often been said, nobody likes to see how the sausage gets made in Washington, because that's basically a lot of backroom deals, tend to get done in order to get legislation through and to get it to the president's desk for his signature. And it needs to be something that the president will sign too. That's the other thing.
Yeah.
So that's
Lot
what
of,
else would you add, Rick, to the
yeah, a lot of
budget
tricky
picture?
stuff here. I mean, I know they want to get this thing done by July 4th. I don't see that happening, but I know they want to go on break. So they might try to not even read half of the stuff and just vote on it. So that's never a good thing. Yeah, I don't have a lot of confidence in them, coming to agreement like that. There's going to be a lot of back and forth on this thing.
Yeah, the legislation is not
Yeah,
going to look like what they passed in the House. I think that's pretty certain. But of course, that whatever they bring back, whatever the Senate agrees to, they have to bring it back to the Senate, and they've got to
right.
kind of hammer out those differences. So the Senate may have to give up a little bit, the House may have to give up a little bit. But of course, if they can't reach agreement, nothing happens, and there is a possibility
Right.
they might have to start over. But nobody's talking about that yet.
No. And this Medicaid is a big issue, that affects a lot of people. When you start making cuts, they start letting people out of nursing homes. I don't know like where that's gonna go, but
Well, there was a big I'm sorry, Medicaid expansion that took place, not nationwide, but only in selected states across the country over the last few years. And it basically brought more people into coverage, uh, primarily low-income people.
yeah,
But I'll use my daughter as an example. She's working part-time and going to school, grad school. And, in Massachusetts, she is covered by she's off our health insurance now. So she needed to get her own health insurance. And she qualifies under the Medicaid rules because her income is so
yeah,
low from her part-time work, and she's not fully into her career yet. So it's people like that. And she's kind of a perfect example, someone who's able to work,
mhm,
uh,
yeah,
but and doesn't have any dependents. And she is working, of course, but she's not making enough money
right.
to be above the very low income poverty level that qualifies people. But
Yeah,
that would be eliminated. So, in her case, she'd need to find health insurance through some other form, paying for a full price outright, or or some other maybe limited policy if she can find something like that. It's going to be tough for some people, no doubt.
yeah, yep.
And I guess just the
Any,
last thing too is just kind of like as you're thinking about, as we're kind of thinking about, the impact of tax cuts, it is kind of like that, sugar high for the economy in a way where it's that, short-term benefit for companies and markets where they, kind of look at what's happening today. But again, it is kind of kicking the can down the road when it comes to these deficits in the long run. Um, and I guess the other thing to note too would just be that like, we always talk about increase in personal income tax rates. There's other, I guess as financial planners, we're looking at other aspects in terms of, Social Security wage bases in terms of like how much of your income is actually going towards some of these systems like Social Security, Medicare. Right now it's only the first 170 odd thousand or so of your wages are going to the Social Security system. So adjustments there down the line, things of that nature are likely to, adjust as if the deficit does grow and we're looking for ways to address it.
Yeah, they've been kicking that can down the road since day one, I think. If us and our clients acted this way and just kept getting a new credit card every time we just ran out of money, I don't think it would be good. And we would advise against that. But as you know, the government's not listening to us. So they do have to cut spending in certain areas. It's just it's not an easy task because we're not all going to agree where spending should be cut. Defense makes up a pretty big piece of the budget, and that wants to be increased by the current administration. So yeah, it's not ideal.
Right. What does Congress want to bring home to their districts? They want to say, we're going to replace that bridge that's been falling apart in your neighborhood, your town for so many years, or that bridge that had to be closed, or we want to, uh, redo the roads in a certain city or town. And, the federal government provides huge funding for a lot of that. And then also with people retiring, of course, which, a number of you on the call are uh, either looking forward to that or in that space currently. Supporting Social Security has for a long time been a third rail, so to speak, of um, in terms of a potential funding cut. Voters do not want to see that happen. And many in Congress have realized that, the opposing party will take them to task if they even start to briefly hallucinate about reducing Social Security benefits. So it puts uh, Washington in a very difficult position. I'm not trying to justify their position. I'm just saying that, like, I think this is how we've gotten to where we are, um, because people love to bring money home to their districts and, you know, take that old fire station and turn it into a youth center or, and a lot of these things get funded by federal government
Yeah.
grants and, medical research. I mean, we're learning about all these things that the federal government has funded in the past that uh, are covered by, the budget spending. So it's going to be a difficult year, I think, where you know, the U.S. is going to be debating what's the right path, how much deficit
Yeah.
spending is going to be okay, how much can we live with, um, where do cuts happen, what things get saved or protected from the cuts. And of course, I mean, at the end of the day, nobody's completely happy because it's going to affect people in many different ways.
Yeah.
Um, just as a quick side note, for those of you who will probably be looking at your account statements in another couple of weeks for the quarter end, since kind of the last few calls that we've had, we were doing these weekly for a while, and now we're doing them once a month. Um, the Standard & Poor's 500 index so far this year through today's close is up about 1.3% after some crazy downdrafts in April, which made a lot of people concerned and nervous and prompted us to start doing a number of these calls. So there's been a huge recovery since then, and a lot of that, of course, has been the result of President Trump kind of renegotiating or backing off of the strong and high rates of tariffs that were going to be applied. And so right now the market is basically assuming that we're in a good place with tariffs, that there won't be more new tariffs applied, that deals will somehow get struck, and that this will be less of an issue. That's what led to the huge amount of volatility in the month of April. And of course, the strong decline in the stock market as these new tariffs were being imposed. So, kind of
And then
have,
we saw that crazy uptick once there was a hold on the tariffs. It was pretty volatile.
right. It was, I mean, you're absolutely right, Rick. I mean, it was sharp. I
Yeah,
mean, a lot of this is moving on, the social media posts of the president. And some people were, some of our clients were very concerned at that moment of where stocks were down 20% or so. And yet we said, this is not the last chapter in this whole conversation around tariffs. And here we are. It's been well, it's been better than a full recovery. I mean, we're up 1.3 from
yeah,
January 1st. So it would be nice if we could have another 2024 where we had 18, 20% return for the stock market. But, I think we would be happy if we finished the year flat, given all
yeah,
that's taken place.
yeah.
Not that we ever want to accept, you know, a zero or a couple percentage point return. That's never our expectation. And, I think, obviously everybody's account is a little bit different, but, the few accounts that I've looked at look like they're doing pretty well, diversified. They didn't go down as much, and they've recovered some now, post stock market decline. So we'll see what the rest
Yeah.
of the year brings.
Yep.
But I think there were some lessons learned early in the tariff process about that.
Yeah. Panicking is never a good strategy.
And it's really hard not
It is.
to do that. Um, you know, it. Some of you may think that, Rick and Andrew and I and the whole team are never worried about anything, which is hardly the case. We talk about this stuff all the time, and we have meetings every quarter where we formally review the performance of everyone's accounts, um, and want to be sure that we're doing the very best possible job that we can, that people's accounts are invested according to their appropriate risk tolerance and goals. And so it's different for every client. Some people want to take a lot of risk and others don't. So,
Right. And then we meet weekly as well. So, and we never get away from this stuff is the problem.
yeah, and that, we're always entertaining, new ideas are coming up for the investment accounts and, how about this investment? Does this fit with, what some of our clients would, you know, either need or want in their portfolio? Does it make sense? Does it not make sense?
Yeah.
So,
Okay.
so we do have, probably, I think the next thing that, actually, you have a chart after this, right, Andrew, I think?
I do, but have any questions popped into the chat box or anyone want to just you can unmute yourself and ask as well.
Yeah. Nothing in the chat
Yeah.
box yet.
So I might as well move on to the next piece. And you're going to run through this, Andrew?
I can. Yeah. I mean, so we're looking at the FOMC Fed committee, the meeting tomorrow. So we'll hear from Jerome Powell as far as what some of the we call it the dot plot, but what our expectations are as far as interest rates, both starting tomorrow, but then moving forward down the line. And obviously that helps to just guide decisions down the road, and it'll affect things too as you're looking at, the bond market. We'll be making note of that, and expectations for forward moving interest rates will impact bond yields as well. So that's when they meet, and it's typically sometimes it's monthly, sometimes there's breaks in there. So it's June 18th. So tomorrow's the next meeting, the meeting again in July, and there's a break until September. We also added in here July 4th as that target date, kind of, I guess, a self-imposed target date from the new administration for passing that budget if it gets through. We'll see if that comes to fruition or not. Um, August 10th is really just that 90-day pause that we saw as far as between US and China from a trade perspective. So that's a date on our calendars that we're monitoring, and we're expectation is if a deal isn't in place before that time frame, it could be a more volatile market leading up to that date. Um, and I think Lyman mentioned at the beginning that December 31st, that's when those Tax Cuts and Job Act, those the current tax rates from 2018 until this year have been in place. And again, if a deal doesn't, or if the new bill um, doesn't go through, then tax rates would revert back to 2018 levels. So that's kind of their urgency with the new administration, is to get something kind of hammered out
Yeah.
leading up to that deadline.
Yep. And we're not anticipating any big movements on the, as far as the interest rates. That's actually coming up tomorrow.
Mhm.
Yeah, I think current sentiment across the bond market is that rates are going to remain the same for now.
Yeah.
And just keep in mind one thing about the Federal Reserve, which sets these rates. They primarily affect short-term interest rates. So these are, bonds with really short maturities, like could be less than a year or a couple of years. That's if there's a rate increase or a rate cut, it has more of effect on those things than say like mortgage rates,
Right.
which sometimes can move in the opposite direction from whatever the Fed says. So the Federal Reserve has an important say, but it doesn't apply universally across all interest rates. I'd say probably one of the most meaningful effects is if they raise rates, you'll see it in higher money market fund yields. That's usually a fairly immediate impact.
Mhm.
So that's good for any of us that have money in a money market fund. But beyond that, um, it it's somewhat limited impact on like 10, 20, 30-year
Yeah.
bonds that are really long-term uh, bond instruments. So, but they also have a lot of smart people working at the Fed, and the Fed is comprised of like 14 different districts
Yeah.
across the country. So we have a Federal Reserve branch here in Boston that has a bunch of economists, and they analyze local consumer manufacturing and business activity. And it's kind of all gets brought together at these Federal Reserve or the Federal Open Market Committee meetings where they all sit down and talk for 2 days and
Yeah.
try to formulate their policy.
A lot of fun.
I used to know a guy who he was a bond portfolio manager, and he says, who says, bonds aren't fun, because the saying is bonds are boring.
Yeah.
Like you want to be invested in the stock market, right? So he says, who says bonds aren't fun? And he was quite a character. And they have a lot of intricacies that stocks don't have. But it's all part of a well-balanced portfolio to have some of each, of course.
Yep. Okay.
You guys can't come up with any questions today?
Well, we're just waiting and seeing what
We're,
happens.
you know what it is, Rick? It's just that we're that good.
Yeah, we answered all the questions. There aren't any more to ask. Well,
Yeah.
the thing is, we're smart enough to know we don't have all the answers, so we just do what we can. We stay nimble, and I mean, you're right. We do worry about stuff. We just don't act on those emotions the way that the average person might. That's not working with somebody because it's easy. Back in 2008, I can go way back even before that. I'm getting calls from clients that were just like, the world's coming to an end. I'm gonna do this. I'm gonna do that, and that's what we're here for, is to kind of temper some of those emotions and look at the plan and say, you've got some savings, you've got an emergency fund, you've got this, you got that, you'll be okay. And if we had gone with our emotions when the whole tariff thing happened, we would have missed that upswing. So you've got to be really careful with just shooting at the hip kind of thing.
And I know Rick and I look like we were born yesterday, but we do have years of experience watching the market, being investors, and we've learned a lot over the years and understood, how the market reacts to different things that happen, whether it's a, world, economic crisis, or some country declares war on another, or there's an oil embargo, or there's the financial market meltdown. And so we've seen, um, kind of the bad outcomes of uh, using an emotional reaction to, difficult situations. And of course, that's really just what's led us to like our long-term mantra, which is to stick it out for the long term, have a good plan, make sure you're invested correctly in the first place and not taking too much risk, or make sure that you're taking advantage of, a long-term strategy when you can use that to grow your investments. But the shorter term ins and outs that are so easy to execute today, um, we've just seen time and time again, and study after study shows that it does not produce long-term wealth. It very often erodes that. So,
Yep.
if we don't have any other questions, I think that's the end of our presentation for today, right?
Yep. Usually we try to keep it to our 30 minutes so people can get in and out. And we'll be back on July 22nd, Andrew,
Yes,
unless
4 o'clock.
something happens in between then, and we might be here sooner, but we're always here anyway.
Well, we fully expect everybody that dialed in today will be dialing in the dead of July, when it is beautiful weather outside there.
Well, actually,
Nothing
the
else to do.
22nd is a Tuesday,
Mhm.
so it'll probably be sunny. We should have it like on a weekend, and it'll be rainy.
Yeah.
And then we'll be sure people can hop on with no problems.
Yeah.
That's a
Saturday
plus.
midday.
Yeah.
It'll be pouring rain and
I told
50
Andrew
degrees.
I told Andrew we should switch it up, and we should take Mondays and Tuesdays off and work Saturdays and Sundays. At least then we get some sun. Although today, it's kind of cloudy. Yeah.
Yeah.
Yes.
Later on, it's going to get better as the week goes on.
Well, it's going to be in the 90s, like towards the end of the week. We're going to go from my wife complaining she's freezing to the other side. I'm predicting it.
Oh, you got to start putting your sunscreen on. All right. Well,
Okay.
great to
Okay.
see everybody today.
Yes.
Thanks.
Bye bye.
Take
care.
care.
Bye.